Okay, so very good morning to all of you and welcome to this session where we are going to cover your AFM, all your concepts and all your important questions in this session. So the idea over here is we will kind of do so you'll have two materials either on either hard copy which you will get probably around 3 to 4 days. Till that time we would have shared a soft copy, or if you have an encrypted lectures, then that entire encrypted copy would be there. So what we will do is we will take the concept book that we call as a shield and we will do all the concepts from this. Then we will go to the questions. For each chapter we have all the important questions that are there. So we will try to discuss the questions, and wherever required we will try to solve them fully as well. But we will ensure that we kind of revise everything that is done in class on the same day, so that we have a fairly good understanding. And whenever required I will tell you to probably just prepare a little bit, or just go through something or try something on your own, so you ensure that you kind of do that, and that will give you the best results for this batch, where we are trying to optimize your coverage and in the best possible time. Okay, so any questions, and you can put it on the chat box, and whenever it is feasible I'll definitely get back to that on the for the same, or otherwise at the end of the session you can always ask the question separately as well. Okay, so we will start with the orientation first of your AFM. I'm pretty sure that you would kind of have the basic understanding. Over here the course again has MCQs, so there will be 30 marks dedicated to MCQs. At this stage, do you need to do any additional practice for MCQs? My sense is no. If you prepare your core content properly, then you can easily tackle the MCQs. If you still want to practice MCQs, you can look at the ICI BOS material, or we have a separate MCQ booklet that we have shared on Telegram, or we will even put this on Google Drive, which you can refer if you want to. But otherwise, if you focus on your core content and get your core content in place, AFM should kind of do really good for you. In this attempt that went by, people have scored a fantastic. I mean, there are close to 100 odd people from at least our batch who have kind of crossed 80. Even people have scored 90 in general. The AFM scoring, to be honest, has been good in the recent attempt. But having said that, AFM has almost always been a scoring paper. So what pulls you down in your group 1 is sometimes audit, but AFM and even FR kind of really help you get that exemption marks very well. And if you kind of get concept clarity and at the same time do a little bit of pen and paper practice, more so in AFM, you should be good to go. Even if you practice in rough, on your calculators rough, that's fine. Even if you scribble around, you don't do the fair presentation, fine. But when you do that, practicing that on pen and paper does a lot of wonders for you. In case there are some changes or updates, we'll update that on WhatsApp, on Telegram, or on YouTube as well. So if there is any changes, you can get hold of that. And over here we will try to kind of cover all the important questions. Okay, so just a very quick orientation on your AFM. So when you look at your AFM material, within the 70 mark descriptive section of AFM, apart from MCQs, you will also get some theory. The theory weightage would continue to be around 15 to 20% of your overall paper weightage. Some of this will come in your MCQs, some of this will also come in your main papers. So when we look at the practical areas, we'll do the theory parts at the end, we'll do the practical stuff earlier. You have 11 chapters in our material. We kind of club security analysis and security evaluation as a single chapter. In the study material, there would be around 12 chapters which have a lot of practical coverage. And then there are 3 pure theory chapters, that is financial policy, securitization and startup finance. So these are pure theory chapters. We will do that at the end. And otherwise there are around 11 chapters which have descriptive largely, and at the same time you have some bit of theory. So we'll first focus on finishing these 11-12 chapters properly, and then we go on to the theory part. Okay, so when we look at the first chapter, this is valuation of securities. Now this is a fairly concise index if you compare this with an financial reporting index, which goes for around 30-35 topics, and as a result most of these chapters will make it to the main exam. So you will almost certainly get an exam weightage on valuation, certainly an exam weightage on mergers, on portfolio, on capital budgeting. Means mutual funds, most of the times it comes, but it is not necessary. Even risk management and business valuation, forex and derivatives. So these are your certain, these I would say tier 1 category chapters. All of these are your tier 1 category chapters. Almost certainly would there be some weightage pertaining to these chapters. Now tier 2, you see an average category chapter. So when you look at tier 2, you will see mutual funds and international financial management. So there have been attempts where you kind of get mutual funds, there have been attempts where you get international financial management, but not in every attempt. So I'll put this into the tier 2 category in terms of importance. And chapters like risk management and business valuation, even interest rate for example, would be in tier 2, and risk management and business valuation will be the least important, which is tier 3. Unfortunately, the easiest chapters are the least important ones, so these would be tier 3. In terms of the theory section, these 3 chapters will almost certainly come for 4 marks, or at least 2 of these 3 chapters you will get a question for around 4 marks. So theory is a separate weight. However, from your practical section, this will be your important areas. Are we good to go? Okay, can we start? Give me a shout out and we can start. Okay. Okay, you can use your chat box. Perfect. So let us go to valuation. We have shared a revision planner as well, but before revision planner, we first try to go into the main content. So first we go to the valuation of securities. Now valuation of securities will be a fairly big chapter along with forex. This is arguably the biggest chapter in your material. In your study mat, this goes as security analysis and then security valuation. So what are securities? Basically securities are instruments which you can use for the purpose of, let us say, investing, trading, raising finance, etc. Various forms of instruments can be mainly, let us say, a fixed income instrument, or let us say a variable income instrument. A fixed income instrument can be something like a bond, a debenture, a deposit, whereas a variable income, like something like an equity share or a mutual fund unit, will probably give you income which is variable in nature. So this chapter largely gets divided into 2 main categories. One is the bond valuation chapter and one is the equity valuation section. Other than that, a few other sundry topics like right issue, buybacks or convertibles are also going to be covered, but core coverage would be from bond as well as equity, bond being a little more complex, equity being a little more manageable. Okay, so we'll first start, just a second, we'll first start with bond evaluation. Now what is covered within bond evaluation? How do you define a bond? A bond or a fixed income security is going to get fixed contractual cash flows, and as a result the valuation of any asset, let alone a bond or an equity share in the world of finance, is going to be based on the present value of future cash flows. So over here, in case of a bond, what are the future cash flows we get? Well, we get interest and we usually get principal values. These principal values can be obtained at the end, that is called as a bullet bond, where the entire principal comes at the end, or they can come over the life, which is called as an amortizing bond, in which case, let's say there's a 100 rupee bond and over the period of 5 years 200 rupees of principal is going to be paid. This is called as an amortizing bond. Now usually the interest that the bond pays is also called as a coupon, and coupon is nothing but a percentage of face value. So for example, if you have a bond which has a face value of 100 rupees, the coupon rate is, let us say, 10%, in which case your coupon amount is 100 rupees. What should be the value of this bond? Well, the value of this bond would be the present value of future cash flows. So over here, if I were to see that there is, let us say, a bond, and in this bond the face value is 100, the coupon rate, for example, let us say is 7%, and the term of this bond is, let us say, 5 years. So what is this bond actually going to give me? This bond is going to give me over a period of 5 years, that is years 1, 2, 3, 4 and 5, it is going to give me some cash inflow. So as an investor, how much should I be ready to pay? In the first year it will probably give me 100 into 7%, it is 7, and in the last year it gives me principal as well as the interest. So 100 plus 7, that gives me, let us say, 107 rupees. So when we look at the valuation of this bond, we will say that this is the present value of future cash flows. But when I want to find the present value, I will have to discount this. What is the appropriate rate that you should be using for discounting? Well, it depends on whose perspective you are trying to value the bond. If you are valuing the bond from an investor's perspective, then an investor would see the opportunity cost. That is, if I don't invest in this bond, but if I were to invest in some other bond, what will that other bond give me? That other bond will give me, let us say, 10%, that is a market rate of interest. Let us say on similar bonds, it will, let us say, give me 10%. So I will say that this bond should also give me 10%. and as a result you can try to find the present values. While doing discounting, preferably take the discount factors up to 4 decimals and round off the fourth decimal. So over here this will be 0.9091, 0.8264, 0.7513, 0.6830 and 0.6209. You do 1 divided by 1.1 equals to, and then you try to find the present value. So if I were to find the present value, this is 7 into 0.9091 and so on and so forth. This will probably come to around 88.63. You can verify this if you want, but it will be around 88.62 or 63 as I guess maybe. What does this number indicate? This number indicates that if an investor wants to invest in this bond, which is giving a 7% coupon for a period of 5 years, and this investor wants to make a 10% return, how much should this investor actually invest? They will invest 88.63. If I were to invest 88.63, then this bond would give me a 10% return. However, what if so this is called as the intrinsic value of the bond. What do you mean by intrinsic value? It means the value based on the future cash flows. Cash flows is inherent in the bond, so the value based on the future cash flows is called as, let us say, the intrinsic value. This is called as the value of a bond or intrinsic value of the bond. Now, if nothing is given, we can assume that the market price will equal to the intrinsic value, because if the market is efficient, then the price in the market will be the same as the price as required as per its cash flows. However, it is not necessary that the market is efficient, in which case what if the question specifically tells you that the market price of this bond, you guys quickly answer in the chat box, okay? You can use short forms as well, that's fine. What if the market price of the bond is, let us say, 90 rupees? What do you guys think? Will we buy this bond or not? The market price is 90, the intrinsic value is 88.63. No, you will not buy this bond. These bonds are called as overvalued. Why? Because the true value is 88. In the market, it is available at 90. You will not buy it. These are overvalued bonds. In fact, you will sell it. On the other hand, if the market price is 85, what do you guys think? Will we buy this bond? If the market price is 85, the true value is 88. The market price is, let us say, 85. It is undervalued. It is available at a cheaper rate, and hence you will buy it. So over here, these types of bonds are called as undervalued bonds. Very nice. Keep on responding, and it will give me a clear understanding of how you are progressing. So over here this is 85, but the problem is a lot of times in the exams the institute tells you to calculate a market price. It just gives you this bond and says, well, you know what, calculate market price. In some questions it says calculate the intrinsic value. In some questions it will say calculate the present value. A student is usually confused looking at the different terminology. One needs to be remembering that unless otherwise given, the market price is going to be the same as the intrinsic value, because if the market is efficient, then whatever is the intrinsic value, that will be reflected as the market price. If a separate market price data is given, you will consider that and then take a decision on whether the bond is to be purchased or not. So this is your general understanding in terms of valuation of a bond, which is valuation considering present value of future cash flows. Future cash flows over here will be interest and principal cash flows discounted at the required rate of return. Usually, if I'm evaluating from an investor's perspective, I will look at the opportunity cost, market rate of interest, and find that that is what I should be requiring. Whereas if I'm sometimes looking from the issuer's perspective, so the issuer wants to give a return of 11% to the investors. Now, the market rate of interest is only 10%, but sometimes you might see that some IPOs etc. get oversubscribed, probably because in issuer wants to give you a very good return. So if the issuer wants to give you a higher return, he wants to leave something on the table for the investor. He might say that I want to give a 11% return to this investor. It is okay in the market, everyone is happy with 10%. I want to make them happier. I want to give them 11%. The question says, okay, two things, you tell me, okay? The question says calculate the issue price of the bond. If the question says calculate the issue price, I will take the present value of future cash flow, discounted at what rate? Quickly answer. At 10%, that is a rate that the investors expect, or 11%, that the rate that the company wants to give. Very nice. 11%, because you are asked the issue price. Issue price is from the perspective of the issuer. If the issuer wants to give 11%, the issue price should be determined considering the discount factor at 11%. However, if the question asks you to find the value of the bond for a particular investor, if I want to find the bond value for a particular investor, for an investor, will I look at the 11% rate to be given by the issuer or 10%, that is my minimum required rate of return? That is right. I will take 10% in such a case. So you have to be careful what is asked in the question. For a similar set of question, if issue price is asked, discount rate is what the issuer is willing to give. If instead of issue price, you are asked to find, let us say, the value of the bond, then you will take the return that the investor expects. Okay, so this is regarding the first part where you are trying to do the bond valuation, which is a present value of interest as well as redemption, where the discount factor is the required rate of return from the debt securities. Okay, sometimes a special case over here maybe acha, is there another faster way to find 88.63? Yes, you can calculate something called as PVAF. When can you calculate an annuity factor? Annuity factor can be calculated whenever your cash flows are same in each year. So over here, are the cash flows same in each year? Yes, and hence we can say 7 into, just a second, sorry, I think I'll have to charge my pencil. Okay, 7 into the PVAF at the rate of, let us say, 10% required rate of return for a period of 5 years. When can we do that? We can do that whenever the cash flows are constant, when the cash flows are equal in each year, we can use the PVAF. Here the cash flows show an annuity. Now certain cases, just a second please, in certain cases, just give me a couple of minutes and we will I'll just get my iPad screen back. So in certain cases what might happen is, this same bond might give half yearly cash flow or a quarterly cash flow or let us say a monthly cash flow. Can my bond valuation be the same? Can I still take 7 rupees in year 1, 7 rupees in year 2, all the way up to 5 years? The bond is giving me a half yearly cash flow, which means 100 rupees into 7%, that is equal to 7 rupees per annum, into 6 by 12, that is equal to 3.5. So you guys tell me, I will receive 3.5 in the 6 months, then 3.5 after another 6 months. That is, I am receiving at the end 7 rupees at the end of the year. Can I still do the same valuation? No. Why no? Well, because 3.5 received after 6 months is not equal to 3.5 received after 1 year, and as a result I will have to incorporate time value properly. So how will I incorporate time value in such questions? In case the cash flows are not annual, in most questions you will see in the exam the cash flows are annual, but if cash flows are not annual, then what will we do? We will try to find the coupon, let us say half yearly. So that will be 7% per annum becomes 3.5% for 6 months, so that is 3.5 rupees. But if your coupon is half yearly, your required rate of return, which was 10% per annum, will also be adjusted to a half yearly rate, that is 10% per annum will be equal to 5%, let us say for 6 months. But now you are going to receive this, earlier you are going to receive 7 rupees over a period of 5 years. Now you are going to receive this 3.5 rupees over how many years? Well, this 3.5 rupees is going to be received over 5 into 2, that is equal to 10 half years. So basically the rule that you have to remember is, whenever the cash flow is not an annual cash flow, then you will divide the coupon, for example, by 2 if it is half yearly, by 4 if it is quarterly, by 12 if it is monthly. Divide the discount factor also by 2, because if the coupon is for 6 months, the required rate of return should also be viewed for 6 months. And lastly, you will compare and find the term, the tenure into 2, because if there are 5 years, then 5 into 2, 10 half years, or if there are 5 years, 5 into 4, that is equal to 20 quarters. Are we clear with this? Yes, okay. So these are the general rules and principles that you should kind of remember. Now, considering that, if we try to practice a particular problem, go to question number 1 on page 1. Over here, you will see certain QR codes. You can actually scan those codes, and there will be an audio note where I am trying to explain in brief about the problem. Don't do that all the time when you are revising. If you're stuck in a particular question, that is when you kind of scan and listen to the audio, so that you can most of the times get clarity on the treatment. Secondly, so you can scan and go to any audio player like a VLC player or any audio player, and this should play. If it does not, you can contact our team. Second, we have also given over here references to the main book. So this is, let's say, the recent AFM fast track that we did, let us say, at the start of 2024, or the regular batch that we have done in 2024. So in case you don't have the hard copy of this material, you can use the main book, and in our main book, if you have, you can look at that relevant question number which we are going to cover over here. Are we clear with this? This is question of the main book. If you have purchased the lectures earlier, maybe in 2022 or 23 or 21, the question numberings might be different, and hence you might have to find the question However, from the 2024 batches, this would be the relevant question numbering. Okay. So over here, let us review this. Question number 1. A 6-year bond of 1000 rupees has an annual rate of interest of 14%. Okay. This is an annual rate of interest for a 6-year bond. Okay. The interest is paid half yearly. If the required rate of return is 16%, unless given otherwise, required rate of return will be per annum. What is the value of the bond? Acha, what is the important thing that you will highlight? What we will also try to do is, while we are doing, we will try to emphasize certain areas where you want to revise. So in this question, the additional adjustment is a half yearly adjustment. So you should know what is to be done for a half yearly cash flow. So in case as a half yearly cash flow, we will say 1000 into 14%, that is equal to 140 per annum. You guys tell me, will my coupon be 140 per annum? No, 140 is for the entire year. Since it is half yearly, 140 divided by 2, can I say that is going to be 70 for each half year? Similarly, my required rate of return is 16%. But again, 16% unless otherwise given is per annum. Tell me, how much is the required rate of return for each half year? 16 divided by 2, that is equal to 8%. But now comes the tenure. This is actually a 6-year bond. What is the term you should take? 6 years are equal to how many half years? 6 into 2. So this is 6 years into 2, that is equal to 12 half years. And as a result, when we try to find the value of the bond, that is the present value of future cash flows, that is 70 rupees into the present value factor, annuity factor, at what rate? Well, at 8%. Now, but 8% is for 1 half year. How many such half years are there? Well, 10 half years. So you can take 1 divided by 1.08 equals to. So you can keep on doing this 12 times. And hence, you will get your answer. Either do grand total GT if your calculator supports, or equals to M plus and then MRC. This is a pure mathematical process, and this will give you around 7.5361. 7.5361. But other than that, I'm also going to get the principal back. Well, how much? 1000 rupees. When is this 1000 coming? This is coming again at the end of the 12th half year, and hence this is 8% for the 12th half year specifically, and hence this comes to, let us say, 0.3971. If I were to do the math, I will get the answer at around 924.64. Now at this stage, this will give you the mathematical answer. Perfect. We will stop over here usually. This is a question where you are doing a simple bond evaluation, just that there is a half yearly angle over here. But what I want you to do in the exam is, unlike FR, where there is a thing that your balance sheet can tally, and at least it can give you an artificial sense of comfort that, okay, balance sheet has tallied, that things are going right. In your AFM, you don't have that luxury, and hence you need to develop some tricks, some techniques, some rules in your mind if you are comfortable. If not, otherwise you take 924, nothing matters, so that you know that your answers are going in the right direction. Sir, what can we think? Well, over here, the coupon rate over here is 14% per annum. We can take it 7% for 6 months, whereas the market rate of interest, remember, discount rate is nothing but your rate of return. So let us say your discount rate, there are various discount rate, market rate, various things can be used over here, is, let us say, 16%. So the relationship over here is coupon is less than discount. Now ideally, what do you prefer? You prefer to receive a higher coupon, or you prefer to receive a lower coupon? If I am investing in a bond, what do I generally prefer? I would generally prefer to receive, answer quickly please, higher coupon. You may even write H and L, it's fine, I want your response, okay? Let it be interactive that way. I would prefer a higher coupon. So you can even write H and L, that's fine. Higher coupon or lower coupon, I will prefer a higher coupon. Now if I want a higher coupon, if I see that in the market everyone is giving 16, this bond is giving 20, that is a premium bond, I will be ready to pay more than the face value as well. However, in this bond, everywhere in the market I am getting 16%, this bond is giving me only 14%. Is that a premium bond or is that a discount bond? Well, it is a discount bond. So when I read the question itself, in my mind, on merely reading the question, there should be a hint that, okay, this is a bond which is not a premium bond, it is like a discount bond in general, and hence my answer should be less than face value. If it is a discount bond, I will pay less than 1000. If the bond had superior features as compared to the market, I will be ready to pay more than the face value. But if the bond has slightly inferior features as compared to that of the market, I will not even pay the face value, I will pay lesser than the face value. This is kind of a general hint, might apply in most of the cases where you compare the coupon rate with the discount rate. If the coupon rate is higher, you guys tell me, if the coupon rate is higher than the discount rate, my answer should be higher than the face value, or my answer should be lower than the face value. When coupon is greater, let's say coupon was 18, market rate of interest was 16, my answer should be higher than the face value. On the other hand, when the coupon rate is less, it's an inferior bond, in which case my answer should be higher than the face value or lower than the face value. Less. Perfect. However, a very important understanding from an exam perspective is, this is where the institute tests you. What if the coupon rate is equal to the discount rate? What if your coupon rate was also 14%, your required rate of return was also 14%? What would be your ultimate answer in such a case? In such a case, your bond's price would ideally be equal to the face value. And this is where institute sometimes remains silent. What the institute says is, a bond which is trading at par has a coupon rate of 14%. Understand the language. They will say a bond which is trading at par. So if the bond is trading at par, we will say that if the bond trades at par, that means the face value, that is a par value, is equal to the market price, whose coupon rate is, let us say, 14%. But it does not tell you anything about the discount rate. It does not tell you the discount rate, the market rate of interest. What should be the discount rate in such a case? If the bond is trading at par and the coupon rate is 14%, then what will be the discount rate? It will be the same as the coupon rate. That is right. If your coupon rate is 14, your discount rate will also be 14, because this is a hidden adjustment. Over here, when you are looking at these key points, this is an important key point. When the coupon rate is equal to the discount rate, the market value is equal to the face value. This is like a par value bond. In other cases, you can cross compare and say that should the bond be trading at a premium or should the bond be trading at a discount, and accordingly come to a particular conclusion. Okay. So this is your basic bond valuation. Any problem still now? No? Okay. So over here, a very important relationship. Okay. Let us say the bond's market price today is 924. The bond's price that we just saw is 924. The market rate of interest today is 16%. Now the thing is 16% per annum, that is 8% for 6 months. Now the thing is, the bond's term is defined in the contract. The bond's coupon rate 14% per annum is defined in the contract, but market rate of interest depends on what the RBI is doing. So if RBI suddenly comes in and it reduces the discount rate, so it goes from 16 to 15%, or RBI might come it and it comes and increases the discount rate. There are two possibilities. RBI does not announce a discount rate per se. RBI says that I am increasing the rate of interest. If RBI increases, banks will also increase. RBI says I am decreasing the interest rate. If RBI decreases, usually the banks will also decrease. So my question is, I valued the bond currently at 924. How did I value it at 924? Well, 70 into the PVAF at the rate of, let us say, 8% for a period of 12 half years, plus 1000 into the present value factor at the rate of 8% for the 12th period. I found the value. Now my thing is, all else remaining constant, the very next day RBI comes out with an announcement and says that the rate of interest is now going to be 15%. That is, there is a fall of 1% in the rate of interest. You have to figure out, we can do the math and find the answer, but irrespective, you guys tell me conceptually, okay, don't touch your calculator. My current answer is 924, as I can see in question number 1. If the market rate of interest gets revised to 15% per annum, that is 7.5% for 6 months, what do you guys think? Will my bond value go up? That is, from 924 it will go up, let's say towards 950, or it will go down. From 924 it will go towards 900. What do you guys think? We want to understand the relationship. Conceptually, the relationship between the market rate of interest and the bond's price. Very nice. It will go up. There is an inverse relationship between the market rate of interest, that is also called as a discount factor, and the bond's price. There would be, remember, an inverse relationship. Now what is the reason for inverse relationship? One is a conceptual one, that is, the bond is giving me the same, but now I require less, in which case the bond is worth higher for me. Mathematically, why should that be the case? Well, mathematically what will happen is, when I actually do 70 into the PVAF, if I do the calculation, 70 into the PVAF at the rate of 7.5% for 12 periods, plus 1000 into the present value factor at the rate of 7.5% for the 12th period. So this is 1 divided by 1.075. So this is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. This is probably 0.4199, and if I do a grand total, this is 7.7353. So if I multiply, this is 70 into 7.7353 m plus 1000 into 0.4199 m plus MRC, and this is around 961. I will get 961.37. The rupee values you will keep up to 2 decimals and the discount factor 4 decimals. As you can see, the bond price is going up. Sir, why is it going up? Earlier, this 70 I was multiplying by 1.08. Now I am multiplying 70 into 1.075. Remember, if the denominator reduces, the answer is going to be higher. And so if you divide something by 8 versus dividing it by 7.5, dividing by 7.5 will give you a higher answer, and hence mathematically this will always be higher. You need to remember this, that there is an inverse relationship between the price of a bond and market interest rate. This is helpful in bond strategies. Say if going forward there will be questions where they will say that the market interest rate is expected to go down by, let us say, 1%. What should you do? You will then think that, okay, if the market rate of interest goes down, bond price will go up. If bond price goes up, which bond should I buy, and so on. Are we clear with this? Yes? Any problems here? Okay. So over here, this is considering your workings. Now, sometimes what happens is you are asked to find the returns. So over here, we have done some basic working for finding bond value. Sometimes you are asked to find returns. How will I find the return for a bond? Let us say if I were to look at this first bond that I took as an example, where let us say the market price of this bond was 88.63. Coupon of this bond was, let us say, 7%. Face value was, let us say, 100 rupees, and the term of this bond was, let us say, 5 years. It can be some other time frame as well. Let us say we, for simplicity, take it as 4 years. The value will be different. Just a second. 1 divide around 7 into, let's say, just a second, 3.17, and 100 into 0.68 m plus MRC. Let's say it's around 90 rupees. This is a 4-year bond. 90.19 is its market price, and these are the given data. Now what happens is you want to find, okay, what is the bond value? How will you find the bond value? If you want to do the bond valuation, the value of a bond is the present value of future cash flow. 7 into 3.17, this is a PVF at the rate of 10% for a period of 4 years, plus 100 into the present value factor at the rate of 10%, let us say, for the 4th year. And accordingly, you will find a particular value. Let us say this comes to around 90.19. Let us say this is simple bond valuation. But now I am going into the return concepts. I want to find how much return is a bond giving me. What is the return bond gives me? On a simple term, someone will say it is interest. How much is a bond giving me? 7 rupees. But 7 on what? Will I take 7 divided by 100? Or will I take 7 divided by 90? What will I take? I want to find return on investment. That is right. I will take 90.19 because it is return on investment. Let the bond face value be anything. I have not invested in the face value. And hence 7 divided by 90.19 will give me in percentage 7.76%. This number is called as the current yield. You have got questions where the institute asks you to find current yield. This is the interest divided by the bond's price. What do you guys think? Is this a foolproof? Is this the best way to calculate return? No. Why? Well, this only considers the interest. It does not consider a potential capital appreciation. You have invested 90 and you are getting back 100, and hence your sources of return is not just the current yield. Current yield is one of the ways, interest divided by price. But we should also consider time value because interest is received over the years. We should also consider capital appreciation, yes, and hence there should be better measures to find the return. So another method to find the return is something called as a realized yield. What do you mean by realized yield? You use the compound interest formula over here. You say how much are we getting? Well, you are getting year 1, 2, 3 and 4. We are getting a cash inflow of 7, 7, 7 and at the end 107. So total all of them put together will be, I am probably getting 128 of cash flow. 7 in the first year, 7 in the second year, 7 in the third year, 7 in the fourth year and another 100 in the fourth year. So I am saying that if I invest 90 today, that 90 will ultimately become 128 after 4 years. So if I use the compound interest formula Under the compound interest formula, my formula is amount equals to principal into 1 plus r raised to n. This is a simple formula that you use. So I'm saying that today if I start at 90.19, after 4 years this totally comes to 128. So what is the rate? This is also called as the CAGR. What is the compounded annual growth rate? What is the rate for a period of 4 years? Therefore we will do 128 divided by 90.19 equals 1 plus r raised to 4. Therefore 128 divided by 90.19 comes to 1.4192 equals 1 plus r raised to 4. So this you will take the fourth root. On your calculator you can take the fourth root. You can't take the fifth root, you can't take the sixth root, for which you will have to use logs. We will see later on how to use logs directly on your calculators only, without really referring the log tables as well. But at this stage, rather than making it unnecessarily complex, if I were to see that if I were to invest 90 today, that 90 will become 128, let us say after 4 years, which means what is the average rate of growth? So if I do square root once and twice, that will give me the fourth root. Therefore, I can say the fourth root of 1.4192 will give me 1 plus r. Therefore, this answer will be 1.0914 will give you, or 1.0915 will give you 1 plus r. Therefore, r is equal to around 9.15% per annum. This is called as a realized yield. Now, what do you do? Realized yield institute does not test you as often. Sometimes it asks you about current yield. Realized yield is the rarest in my opinion. I've hardly seen any question coming from realized yield in the exam. But what is happening in case of a realized yield? I am trying to say that in case of a realized yield, if I were to start at 90, how much will that total cumulative become at the end of 4 years? That will become 128 rupees. So on an average, you are earning how much? 9.14 or 15% per annum. Are we clear with this? Is everyone clear? Can you tell me a drawback of this method? This method seems to be considering 90 rupees, that is your investment. It is also seeming to consider you are getting 100 back. What is a big drawback of this method? Can you tell me? Well, if there was another bond, for example, if there was another bond, this is bond 1. Let's say if there was another bond which gave you your 1, 2, 3, 4, 0 rupees, 0 rupees, 0 rupees, and it suddenly gave you 128 at the end of the 4th year, like a zero coupon bond does, will my realized yield, if I were to have 90.19 of investment, at least will my realized yield be the same? Yes. However, are both bonds similar? Given a choice, which bond will you buy? The first one or the second one? Which of the two bonds will you? The first one. Why? Because this bond is going to give you cash flows earlier as compared to the other bond which is going to give me later. Now realized yield ignores that, and hence realized yield is also not one of the most popular methods to calculate return. So when you calculate return, first is current yield, as we said, interest divided by market price. Here you don't even consider the capital appreciation, not even time value. So this is the worst way to calculate yield. But if data is not available, like you don't have the number of years, or data is not available where you don't have the redemption value, well, current yield is the only way in which you can find the yield. However, in certain cases, an improvisation over current yield would be a realized yield, where we take the total of all the cash flows till the maturity and then use the compound interest formula. But again, the drawback of this formula is it does not correctly consider the time value. So what is the best way to calculate return? The best way to calculate return is called as the yield to maturity. What does YTM mean? Now, yield to maturity, or YTM, has two pillars. It says YTM is the rate. YTM means yield, that is return. TM means to maturity, which means it is based on two premises. First, YTM is the rate that you will earn if I were to purchase the bond at today's price. If I were to purchase at today's price and hold this bond till maturity. So if I were to, let us say in this question that we just did, let us say you were not given this discount rate. We were not given this 10% rate. You are just given data like the market price today is 90.19. The face value of the bond is, let us say, 100. Coupon is, let us say, 7%. And the term is, let us say, 4 years. Now the problem is, I am an investor, like in your CA Inter capital budgeting, sometimes to decide whether I should invest or not, I look at NPV, net present value. But sometimes I also calculate something called as IRR, the internal rate of return. What is IRR? IRR is a rate at which the present value of cash outflows, PVCO, equals the present value of cash inflows, that is PVCI. So I will say that, okay, if this was also a capital budgeting project, like I'm constructing a bridge, highway, dam, I'm buying a bond. What will be my PVCO? If this was my capital budgeting project, what will be my cash outflow? If I want to purchase a bond at today's price, my cash outflow will be 90.19. When will I incur this? Well, this will be incurred at year 0, today, immediately. Okay, however, I want to find PVCI, present value of cash inflows, PVCI. How will I calculate PVCI? Well, I don't know the rate over here, so I can do something called as trial and error. So in trial and error, what do I do? Well, I say I take a random rate. Let us say I take a rate of 10%. So I take a random rate. I say at 10%, 7 into 3.17 plus 100 into 0.68. Now these are the discount factors. Trust me that this is the 10% factor for 4 years. This is 10% factor for the 4th year. You can even verify that. If I do this working, probably I will get 90.19. Now what does this mean? This means that if I were to invest the bond in the bond today, my cash outflow is a certain cash outflow of 90.19. But if I hold it till maturity, I'm going to necessarily get 7 in year 1, 2, 3 and 4. And then at the end of the 4th year, I'm going to get 100 rupees. And hence, if I try to calculate, my IRR, IRR is the rate at which PVCO equals to the PVCI. At 10% PVCO, in this case, coincidentally is equaling to PVCI. In your exam, you will almost certainly have a situation where it does not equal, and hence you will have to use a technique called as interpolation. However, over here, 10% is your IRR. Well, what you call as IRR in capital budgeting language is called as yield to maturity in the most accurate way in case of your bond valuation. What is yield to maturity? Yield is a return. The return that an investor will get if the investor were to purchase a bond today and hold it till maturity. On an average, the investor will get 10% return. This is the gold standard. If you open CNBC Economic Times and you see bond yield, always that is a bond yield to maturity, not the realized yield, not the current yield, anything. If you open financial publications, bond valuations are not usually given in terms of bond prices. Just a second. A lot of times bond valuations are given in terms of bond yields, because a investor, let the bond price be 90, let the bond price be anything. The investor is interested in earning a fixed interest return. So I want to really know that if I were to buy this bond, what is the true return I am getting, considering capital appreciation, considering interest, considering time value, all said and done. What I get is called as a yield to maturity, and that is a gold standard when it comes to bond valuation. So this is 10%. Now remember, in a lot of sums, this rate is given to you. That is nothing but what an investor wants to earn. So if I take that as a discount factor, I say, okay, let's say 90 rupees of price was not given and we were just given the bond, and investor said, I want to earn a yield of 10% till maturity. This bond is giving me 7 rupees each year for a period of 4 years and 100 rupees at the end of the 4th year. I want a yield till maturity of 10%. What should be my discount rate? If investors required yield to maturity is 10%, what should be the discount rate? What should be the discount rate? Just a second. Yes, the discount rate over here is, let us say, 10%. The discount rate over here, let us say, is 10%. So in this particular case, when we are trying to find the discount rate, we will take the investor's required rate of return. So why are we discussing this? At this stage, you might think that what is the point of this? A student gets confused when they are revising. They are unable to differentiate between a discount factor, between market rate of interest, between yield to maturity. Instead, to uses these words interchangeable. It sometimes in a questions will say that an investor expects a yield of, let us say, 10%. and they take that as a discount rate. Sometimes they will say that the market rate of interest prevailing is 10%, that they take as a discount rate. Of course, if discount factor is given, that is going to be taken as a discount rate. But remember, these words are used interchangeably. Like in the beginning, we said that intrinsic value and bond price are used interchangeably. Okay, if nothing is given, whatever is the intrinsic value must be the bond price. However, if we are specifically given, uh, if let us say we are specifically given that a market price is different, we'll take that. In a similar way, if nothing is given, whatever is the market rate of interest is what should be your discount factor, or whatever is your desired yield to maturity should be your discount factor. Are we clear with this? Is everyone clear? Okay, so now we will apply this yield to maturity. Now, yield to maturity can be calculated in an approximate manner. Remember, this is called as the trial and error method, and in my opinion, this is the best way to calculate yield to maturity. However, yield to maturity can also be calculated in an approximate manner. Should you do it in the exams? I would not recommend. However, if you're running out of time, again, remember, you have to score marks. Stepwise markings does not mean you are just filling up pages. Stepwise means you reach a particular step in which institute can give you marks. So over here, if you're running out of time in the exams, which will be most of the times, then you can use, let us say, a shortcut to find the yield to maturity, where you would say YTM would be what? Well, I would say YTM would be my interest, that is 7 per annum, plus there would be some capital appreciation. So 100 rupees minus 90.19. This is a capital appreciation of around 9 rupees. But remember, interest is coming every year. Capital appreciation comes only once in 5 years. So if I want to find per annum, I will say that on an average, 100 minus 90.19, that comes to, let us say, 100 minus 90.19, that comes to, let's say, 9.81, is a capital appreciation which is once in 5 years. So on an average per annum, it will be divided by 5, that is 1.96. So I will say that my return on an average is 7 plus 1.96 on an investment. You can either take 90.19, or what institute sometimes does is it takes the average investment divided by 2. So it says, okay, like if you have done amortized cost working in FR, that 90 will slowly go up to 100. So institute takes the average investment. Say over the tenure, the average investment is, let us say, 90.19 plus 100 divided by 2 comes to around 95.1 approximately. So this will give you 7 plus 1.96, that is 8.96 upon 95.1 in percentage comes to around 9.42%. This, remember, is an approximate yield to maturity. The accurate yield to maturity is actually 10%, but this is much more faster. In fact, you can use this on your calculators to arrive at a starting point. Like over here, a question might have arisen that, sir, how did you pick up this 10%? Well, it was random because I knew the answer. However, if I did not know the answer, then how will I pick up this? I will probably try to find the yield to maturity using this approximate method on my calculator. Don't even show it to the examiner. Comes around 9 point something, and hence you can start at around 9 or 10. It's a good starting point. Okay. So this is regarding your approximate YTM as well as the accurate YTM using trial and error. If you have the time in the exam, I would strongly recommend that you calculate YTM using the trial and error method. Now within trial and error method as well, there can be a problem. Like in our example, we took the market price of the bond to be 90.19, but is it necessary? It has to be 90? No. Let us say all else remaining constant, the market price was around 92 rupees. All else remaining constant, the bond still has a face value of 100, coupon rate of 7%, term of 4 years. Now if I look at IRR, I will do trial and error. Let us say at 10%, if I do the working, I come to 90.19. Acha, at 10%, is my PVCO equals PVCI? No, at 10%, this is my PVCI. Present value of cash inflows at 10% is 90.19, but my PVCO is 92. I have to spend 92 rupees. So here I have to do trial and error. I have to say that, okay, my target has to be a number above 92 and a number below 92. I already have a number below 92, and hence I need to increase this value. Acha, if I have to increase this value, you guys think and tell me. Oh, sorry, that's right, my bad. This was 4 years, my bad. This is divided by 4, and hence this is what? This was a 4-year bond, not a 5-year bond. Good observation, this is 2.45. So if you get 2.45, 7 plus 2.45 divided by 95.1 will come to around 9 point something, right? So it will be 9.93 or something. Okay, so what do I do? Well, if I want to increase the present value, what did we study? Are they inversely related or directly related? If I want to increase the present value, I will have to decrease the discount rate. So I go to, let's say, at 9%. Remember, there's an inverse relationship. If I want to increase the present value, go above 90, 92, then I should decrease my discount rate. Okay, therefore, if I say my PVCO, still I've spent 92 rupees, but PVCI now at the rate of 9% would be 7 into PVAF 1.09, 1, 2, 3, 4, 0.7084, this is plus 100 into 0.7084, and a grand total will be 3.2397, which means 7 into 3.2397 and 100 into 0.7084. If I total, this is 93.52. Acha, if, listen to this, if I had spent 93.52, I would have fetched a 9% return. Am I spending 93.52? No. Had I spent 90.19, I would have fetched a 10% return. Am I spending 90.19? No. Which means I am spending 92. So what do you guys think? Will my return be 9? Will my return be 10? Or will it be somewhere between 9 and 10? What do you guys think? It will be somewhere between 9 and 10. That is right. So over here, use a technique called as interpolation. You need to do some practice, and interpolation is nothing but a sophisticated name for cross multiplication. What do you do in case of an interpolation? We say that, well, we know that the rate is somewhere between 9 and 10. How do you find it? Different ways to which you can solve it. Whatever way you are comfortable, you do it. I will do it in a particular way, which is I will take the higher number minus lower number. So let my desired IRR be X. So between 9 and 10, which is a lower number? Difficult question, sir. Between 9 and 10, which is a lower number? 9. So I say it is, my IRR is above 9 but below 10. So okay, higher number minus lower number. In the denominator, again upon higher number minus lower number. Okay. So this is my LHS. I have taken higher number minus lower number in the numerator, higher number minus lower number in the denominator. On the RHS, I will take the present values exactly at those numbers. So I will say, okay, at X, my present value is how much? Well, at X, I desire 92. At 9%, I have found that this is 93.52. Similar in the denominator, you guys tell me. At 10%, what is the value? 90.19. And at 9%, again, it is 93.52. So basically, I am taking the corresponding present values. What I just need to remember is I take the higher number minus the lower number. And then on the right hand side, I take the present value of those numbers. Do a bit of practice and you should be sorted. So over here, therefore, X minus 0.09 upon 0.01 equals, this will be negative 1.52 upon 90.19 minus 93.52 comes to negative 3.33. Okay, negative will get cancelled. So X is equal to 0.09 plus 1.52 upon 3.33 into 0.01. What is this? This is nothing but cross multiplication. We are saying that when I move by around 3.33, the movement is around 1%. So if I only want to move 1.52, the movement will be how much? So if I go to see, this is 1.52 into 0.01 upon 3.33. So this is around 0.09456, that is 9.456 or 9.46%. This is called as interpolation. Correct. So that is your right answer, and this will give you a yield to maturity. So what we will do is we will try to practice this in a particular problem, which I would definitely rate as important and a type of an exam question which can come. So all the concepts that you have studied over here will get well revised. Question number 2 is a good question, mark it as important. We'll highlight the relevant parts of this question which we need to be careful about. Okay, based on the credit ratings of bonds, Mr. Z has decided to apply the following discount rates for valuing bonds. So based on the credit ratings of AAA, AA and A, 364-day treasury bill plus 3% spread. Remember, treasury bill is risk free. You are slightly more risky. So for that, more return as compared to treasury bill, 3% more return. AA will be AAA plus 2% and A would be AAA plus 3%. He is considering to invest in a AA rated bond, which means for you the relevant rate will be this rate. Of 1,000 face value, currently selling at around 1025.86. So this is currently selling. What do you guys think? This is currently selling at this price. So can we say this is the market price? Okay, market price is given in this question. The bond has 5 years to maturity and the coupon rate is 15% per annum payable annually. The next interest payment is due in 1 year from today and the bond is redeemable at par. So there is 5-year tenure, coupon rate is 15% payable annually, so I don't have to do that 6 months or 4 months adjustment, and the bond is redeemable at par, that is at 1000 rupees. Assume the 360-day treasury bill to be 9%. Okay, so based on that, what should be your required rate of return? Well, if you are holding a AAA rated bond, then 9% plus 3%, that is you would require 12%. However, if you are holding a AA rated bond, then you would require 12% plus 2%, that is equal to 14%. So your answer, that is your required rate of return, should be 14. Okay, you are required to calculate the intrinsic value of the bond. Now a student says, sir, value is given. Well, that is a market price, which may be the same or may not be the same as intrinsic value. Intrinsic value is based on the present value of future cash flows of the bond. For Mr. Z, should he invest in this bond? Okay, you will compare the intrinsic value with the market price and decide, and also calculate the current yield and the yield to maturity on this bond. So a lot of these concepts are getting revised over here. Now before we proceed, what is the coupon rate of this bond in your mind? What is the coupon rate? Well, this is 15%. And what is the discount factor or the market rate of return for a AA bond? 14%. Think and tell me. Think and tell me, will your answer of the bond intrinsic value be greater than 1000 or will it be less than 1000? Think and tell me, will it be greater? Very nice. Because is it a premium bond or is it a discount bond? Yes. So this is the first thing I want you to have it in your mind whenever you are solving a bond question. If you are supposed to do bond valuation, you need to know your answer is in the right direction or not. It will not take more time. You don't have to think and dream about it. Once you practice a little, it will come subconsciously. The moment you read it, you will say, okay, my answer has to be greater than 1000. If it is less than 1000, you will know that you have made some mistake. Okay, so over here, when we look at, let us say, bond valuation, we'll say the present value of future cash flows. This is a bond with a 15% coupon. 1000 into 15% comes to 150 rupees. Let's say question 2. 150 into the present value at the rate of 14% for a period of 5 years. And then this is the annuity factor, and then the simple factor, redemption is happening at par for 14% for the 5th year. 1 divided by 1.14, 1, 2, 3, 4, 5. This is 0.5194 and this will be 3.4331. So if I multiply, this is 150 into 3.4331 and 1000 into 0.5194. If I total it, it will come to around 1034.37. This is the intrinsic value of the bond, but the market price of the bond is around 1025. Think and tell me, is this bond worth buying or is it worth selling? Should you buy the bond or sell the bond? Buy. Why? Because the bond is undervalued. Under or overvalued depends on the market price. The market price is less than the intrinsic value, it is called as undervalued. Market price is more than the intrinsic value, it is called as overvalued. So over here, undervalued. My true value is 1034. But the market price is 1025. It is undervalued. The value in the market is lower than what I expect. That is called as undervalued, and you buy undervalued assets. Very nice. You will buy it. Now the current yield is asked. Now current yield is interest divided by something. Now interest over here is going to be 150 divided by, you have two options. Will you divide by 1025 or 1034? Market price MP or intrinsic value IV? Market price. Why? Because, well, I'm investing 1025.86 as a matter of fact. The intrinsic value may be 1034. If nothing was given, if this sentence was not given, then we will assume that the bond is efficiently priced and the market price will also be 1034. But if it is specifically given that the market price is 1025, well, by the way, it is 1025. And as a result, return on investment, I'm investing 150 on 1025.86, and hence this will give me approximately a 14.62% or 61% return per annum, that is current yield. Now the question asks me to find YTM. I can do it in an approximate manner or I can do it by trial and error. Now I have time and time, so preferably I'll do it the most accurate way. Trial and error will say PVCO. What is a PVCO again? Will it be 1025 or will it be 1034? Well, it will be 1025. So this is again 1025.86. Compare this with the PVCI. The PVCI over here, let us say we take at the rate of what? You can take any random rate. Let's say this is around 14. We've already done the workings at 14. Let's say at 14%. We've already done the working. It comes to 1034.37. So 14 is not the IRR. But I need to take the present value down, which means I'll have to increase the discount rate. So I will go at. Acha, you guys tell me, will I go from 14 to 15 or 14 to 13? Well, I have to go from 1034 to a number below 1034. So I need to decrease the present value. So I will have to increase the discount rate, inverse relationship. And as a result, I'll go towards 15. Having said that, you can even take 16 and do an interpolation over 2 or 3%, maximum interpolation up to 5%. Don't take 10 and 20% differences for interpolating, maximum 5%, preferably around 2 or 3% also will work. So if I do this working, you will get the final answer is approximately 1000. It is just a calculation process. Just trust me, it is around 1000. In which case, now you tell me. If you want, you can pause and think that how will I put the interpolation formula. So I will say, okay, x minus, if you get the formula correct, then it is again a mathematical process. X minus, you guys tell me, will I subtract 14 or will I subtract 15? X minus 14, that is right. In the denominator, 15 minus 14. And as a result, on the right hand side, I will take the present value. In the numerator at x, I need what? Well, x will be when 1025.86 comes, minus at 14%, 1034.37. In the denominator at 15%, the rate is 1000 minus 1034.37. You will do this working down and that will finally give me a yield to maturity. Let us say this yield to maturity comes to around 14.25%. So over here, this is, let us say, around 14.25%. Now, what does this mean? Just for our knowledge, remember you required a minimum return of 14%. We said now, okay, for a AA bond, I will need a minimum required rate of 14%, but this is minimum. In this case, I am earning more than 14. I am earning 14.25%. I will happily accept this bond. So when I look at this bond valuation, I will happily accept this bond because it is giving me a return of greater than 14, that is 14.25. So I can either compare 14% with 14.25% and select that I want to buy the bond, or I can compare 1025 with 1034 and select I can compare the bond and select that I want to buy the bond. Or yes or no. Basically, common sense tells me that if the actual return is greater than what I require, I should buy it. IRR greater than the cost of capital, I should invest in that project. Are we clear with this? Is everyone clear with this question? I would want you to practice this separately, especially this question, for getting a good understanding on YTM as well as bond valuation, and even understanding the difference between intrinsic value and market price. Okay, so that takes care of question number 2. Then we have a question number 3, which is a slightly tricky one. Let us review this. Just a second. Okay. MP Limited issued a new series of bond on 1st January 2010. These bonds were sold at par, that is 1000 rupees, having a coupon rate of 10% and will mature on 31st December 2025. So that is a good 2010, 11, 12, 13, I think around what, 16 years probably, around I think 15 or 16 years. Coupon payments are made semi-annually on 30th June and 31st December. Okay, each year. Assume that you purchase outstanding bonds. Let us say purchase all outstanding bonds, whatever it is, of MP Limited on 1st March 18, when the ongoing interest rate, we are purchasing it on 1st March 18, when the going interest rate was 12%. Going interest rate must be the market rate of interest or the discount factor is 12%. What was the YTM of MP as on 1st January 2010? Now this is a very simple question if you have understood the concept. There are two questions. One is on 1st January 10 initial issue, and then is on 1st March 18, that is around 7-8 years later. They are asking you what is the YTM of bonds on 1st January 10. We have not been given that data. Do I need to do trial and error? Sorry, I'll just kind of get that corrected, but do I need to do trial and error over here? No. Why not? Well, because the bonds are sold at par. Remember we had discussed this. If the bonds are trading at par, can we say that the coupon equals the discount rate equals, let us say, 10%. If the bonds are trading at par, the coupon equals the discount rate, let us say this is equal to 10%. So my answer directly over here will be 10%. I don't really need to do all of that math. Otherwise, I have to find PBCO equals PBCI and do all of this. Well, you could have done that. But otherwise, if the bond is selling at par, we can say with confidence that your coupon rate is equal to the discount rate. Second, what amount should you pay to complete the transaction? Of that amount, how much should be the accrued interest and how much would represent the bond's basic value? Now, this is where students do face some problem, and hence we are covering this right now. Now, this is the only problem where you are buying at a odd date. Now, you are sitting on 1st March 18. Now, from 1st March 18, the next interest payment is due in 4 months. That is on 30th of June 2018. So, how much is the interest payment? It is a semi-annual payment. So, this is 1000 rupees at the rate of 10% per annum. So, can I say 1000 into 10% into 6 by 12 will come to 50 rupees. Now, after this interest payment is made, let us say you are on 1st of July 2018. Now, from 1st July 2018, you are how many years away? Well, from July 2018, so let us say that is July 2019, 20, 21, 22, 23, 24, 25. Again, from 2018, from July 18 to July 19, 20, 21, 22, 23, 24, 25. 7 full years, and then the redemption is happening on 31st December 2025. That is 6 more months. That is 7.5 years away is 31st December 2025. Now, if I were to, there are multiple ways in which you can do this. Okay, this is one of the ways that institute has done, though an alternative way is very much possible. So, if I look at bond evaluation on 1st of July 2018, I will say this is the present value of the remaining 7.5 years. That is 50 rupees into the present value annuity factor. Acha, will I take the original? I am buying the bond on 1st March. If I am buying on 1st March, will I care what the rate was in 2010, or will I take the ongoing rate, that is 12%? Tell me, should I take the discount factor at 10 or should I take it at 12? We'll do some adjustment, but otherwise 12. 12% is per annum. Will I have to make some adjustment? Yes, divided by 2. Remember, coupon rate was 10% per annum. However, you took 10% divided by 2, that is equal to 5%, and hence 50 rupees. The required rate is 12%. Again, remember the required rate is higher, coupon rate is lower, which means this bond will be at, tell me, higher than 1000 or less than 1000? My final answer, it will be less than 1000. Okay, so this is 12% for 2 divided by 2 over the next 15 half years. 7.5 years, that is 15 half years, and then at the end you will get 1000 again at the 15th half year. So this is 1 divided by 1.5. 0, 6, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. Most likely this is 0.4173 and this is 9.7122. Okay. So if I were to do this working, I will get 50 into 9.7122 and 1000 into 0.4173, and hence the total comes to around 902.91. This must be the price that I would pay had I acquired the bond on 1st July 18. Now you guys tell me, am I acquiring this on 1st July 18 or 1st March 18? Acha, from 1st March 18, how will I find this? Well, on 1st July, I will look at only the future cash flows. But let us say I was a day before. Let's say I go to 30th June. On 30th June, if I were to buy the bond on, let's say 29th June, forget 1st July, if I were to buy the bond 2 days before, on 29th June, what do you guys think? Will I still pay only 909? No, if I buy on 29th June, obviously I will get the coupon payments for all of these 7.5 years. But over and above that, I will also get this 50 rupees payment immediately. And as a result, over here, this 902 is called as the X interest price. However, come interest, including interest, I can say on 30th of June, if I were to buy this bond on either 29th or 30th, I will pay obviously for the future interest payments that are coming. But I will also have to pay for this 50 rupees that I will earn. And hence, I will say on 30th June, this is how the institute has done it, and hence I am doing it, though there is an alternative easier way also possible. So on 30th June, I will say this bond will be worth 952.91. This bond will be worth 952.91. Is everyone clear? Acha, but again, am I buying on 30th June? No, sir. I am buying on 1st of March, which means I need to take this back 4 months. So I will say 952.91 in June is worth how much in March? So I will say 952.91 into 1 divided by 1 plus 0.12, this is per annum, into 4 by 12. So I want to take it back 4 months. I am trying to say that I want to find the value in March. 952 which is received 4 months later is not equal to 952 today. 952 is the present value of all future cash flows starting from 30th June all the way up to 31st December 25. So if I do this working, this will give me 1 divided by, so this is let's say 1.03 if I am not wrong, and or 1.04. So this is 952.91 upon 1.04. This comes to around 916.26. This is the value of the bond. However, this is the value of the bond in March. So if the question had just asked you to find the value of the bond, this would be 916.26. However, this is a value in March. Now, can I say this is a value that is after considering 2 months of interest? After 2 months of interest. Remember, the last interest payment date was 31st December 2017. After that, the bond would have accrued 1000 into 10% into 2 by 12. That is probably 16.67 worth of interest. So, ideally, we don't need to bother about this. But the question very clearly asks us that show how much would you pay to complete the transaction. Of that amount, how much should be accrued interest and how much would represent bond's basic value. So we can say that we will pay around 916.26 to complete the transaction on 1st March. But on 1st March, I acknowledge that some interest has already accrued. 2 months of interest has already accrued, and hence out of the 916.26, we can say that 16.67 will be due to accrued interest and the remaining 899.59 would represent bond's basic value. Now this is one way of solving, okay. The other way of solving is, instead of starting from 1st July 18, you can start from 1st January 18. Find the value on 1st January 18 and then take it 2 months forward. And that should also ideally be giving you almost the same answer with some certain degree of approximation. However, I would strongly recommend that if you are solving and this question comes, it was even there in the old syllabus, old meaning the syllabus before 2018, and the institute always solved it like this. Even in the new syllabus, the sum that is there in after 2018 and even after 2024, it is in the same way. So yes, an alternative solution and presentation is possible, but as seen in the past, if we want to be rest assured, we might as well show the presentation and the method that the institute has done to be kind of quite clear with our marking scheme. Are we clear with this? Any problems? It's a slightly tricky question. It does not go very normally in the mind of people like other questions do. They kind of go through. Here, that adjustment from 30th June taking to 1st March, well, what they do is they try to find the value as the present value of all the future cash flows. If you directly do the valuation from March, all the years will be odd years. So we say we don't want that odd years. Let us say we come to 30th June 18, find the value on 30th June 18 and bring that back to 1st March. Can we proceed further? Yes. Okay. So over here, there is question number 4. Go to question number 4. Break, just give me, we'll stop usually by around 12:05 or something. We'll just stop for a break. We'll finish one more question and then we will probably stop for a break. Okay. So question number 4. A 5-year bond with 8% coupon and maturity value of 1000 is currently selling at 925 rupees. What is its yield to maturity? Also calculate its current yield and realized yield. Okay, so over here it's a pure return question where you have to calculate the yield to maturity. So for question number 4, when we try to calculate the yield to maturity, you will first try to find PVCO. So your PVCO is the amount that you spent. In question 4, PVCO is 925 and then you look at PVCI. Now what should be the rate I take? Well, I don't know. There's an 8% coupon. Well, you don't know, so usually you can take that approximate calculation. We can say that okay, 80 rupees is my coupon plus it seems 925 and 1075 is my capital appreciation divided by 5, that is 15 per annum, divided by, on an average you can either take directly or you can take 925 plus 1000 divided by 2. So you can take 80 plus 15 divided by 962.5, that is 95 divided by 962.5 comes to around 9.87, that is a number very close to 10. So if I were to take at 10%, this will give me a good starting point. At 10%, I can say 80 rupees into 3.791 plus 1000 into 0.621. So if you multiply 80 into 3.791, 1000 into 0.621 comes to around 924 point something. For all practical purposes, let us say I take it same as 925. It's actually 924.28, but it is for all practical, it's kissing distance of 925. So let us say for simplicity we take the YTM at 10% only. Otherwise we can probably use IRR method over here. Okay, next is, so this is yield to maturity. Second is the current yield. Current yield is easy. You will say for current yield this will be 80 rupees divided by your investment, that is 925. So 80 divided by 925 in percentage comes to around 8.65%. This is your current yield. And then comes the realized yield. Now in this case realized yield might require some logarithmic values. We will do logarithms later. Already bond valuation is a little complicated. This is the only place where you will need logarithmic values in bonds. Later in derivatives at multiple places you will need logs. We will come to that. So for the time being we will reach up to a stage and then we will kind of derive a particular value. So over here realized yield. Let at least help me in formulating the equation. How will I find the realized yield? So it is a compound interest formula, which means I need the total cash inflows. Can you calculate and tell me what will be the total cash inflows for this bond? 80 rupees in the first year, 80 in the second year, 80 in the third year, 80 in the fourth year and 1080 in the fifth year. So this will come to probably, can I say 1400? Okay, so if I look at the realized yield formula, A is equal to P into 1 plus R raised to N. What is your amount after 5 years? What are you going to get? That is right, 1400. For that, today you have to invest how much? 925 into 1 plus R raised to what? 5. Therefore, 1400 divided by 925 comes to around 1.5135 will come to 1 plus R raised to 5. Therefore, 1.5135, if you take the fifth root, or rather if I look at workings like this, you will say 1.5135 raised to 1 by 5, or the fifth root, is equal to 1 plus R. Now this cannot be solved directly. You will need the help of logs, but again bond valuation is more complex as compared to equity valuation. There is already a lot of complexity. Logs we can keep for some time. Once you reach this equation, if you know how to calculate the logarithmic values, as you can see over here, you will find using logs. So let's say this is your final answer. You will do some logarithmic values and you will come down to 8.6%. Are we clear with this? Yes? Okay. So this takes care of the discussion on yield. On the other side of the break, we will discuss about something called as forward rates, and we will discuss about duration, bonds risk. Okay. So we are done with the bond return and the bond valuation part. We now need to look at the bond forward rates as well as the bonds risk. So we'll stop for a short break. We'll start back by around 12:05. Take a short breather and then we'll be back. Okay.